Hello everyone, this is Juan Sarmiento and today is Friday, March the 24th. I have two suggested trades that I would like to make, but before we do that, let's take a look at our current positions and what we need to do. So far, year to date, we have a loss of $33, 35, 25, somewhere about that. Around there. And so let's examine this, starting with this Adobe. Adobe is really doing really well, so let's take a look at the chart. And yeah, it has been going up. As you can see, the stock reported earnings, the company reported earnings, beat expectations by a wide margin, and then kept rallying. So what do we do now? Well, it all depends on how far up we are. Let's go to the Analyze tab and take a look at the risk graph. And what you need to do is, you see these three bars, okay? The one in the center is the current price, okay? And so you can copy the trade from the Monitor tab, Account Statements, and here it is, orders filled, and you can see that we have this one here. Obviously we had this one here, we got it eventually removed. Now we have this one here, April and July. So let's analyze that trade. Yep, that's the trade, July and April, so we can delete that. And what I like to do is, I usually say analyze opposite, which will be closing the trade, and then open it, open the lock, and then you can see the difference between what I paid and what it's worth now, and if we were to close the position. So let's hide the position and remove deselect the closing trade, and this is $650 so far, and it should match our position. So let's hide the simulation that reveals the position, and you see $647. What I like to do is, I call this curve here the smiley face, the smiley face. If my current strike price, my current price is above the smiley face, in this case we would sell calls or simply roll over. When do I sell calls? When I have more than one, let's say 5 outstanding calls. If I only have one outstanding call, I do a rollover. What is outstanding call? Well, all you have to do is subtract the long calls minus the short calls. That gives you 1 in this case. So we have 1 outstanding call. If there were 2 outstanding calls, that's the difference would be 2. So what do I want to do? Do I want to roll it up? No, only when it goes, say, to 397. If you reset the slices here, you see that the current price is down here at 372. So we don't need to do anything. Okay, we do have $645. If you are happy with that, then you can close the trade. I don't. I look at the implied volatility. Is it, let's say, 60? Well, that's a very high implied volatility. I would definitely consider getting out. And if that were to happen, imagine if we adjust that volatility. If we adjust the volatility here, somewhere here. It's not working for some reason. Usually the volatility you can adjust. Here it is, okay. So volatility adjusting. If the volatility was supposed to increase 10%, 10, oh, it's not working. See, as I increase the volatility, see how my profits will build. Just a little increase of 3% of the volatility would increase my profits dramatically. if it was to go to 50, you can see the volatility here overall. If it went to 50, then my profits will build significantly, and then I would say, well, I'm happy with that, let's get out. See that? 10%, then we have, imagine if it goes to 20%. 20%, the implied volatility would be 60, then I have $5,500, and I say, well, we need to get out of the trade. If you want to, if the stock goes up significantly, let's say to 424, let's reset here. Okay, let's reset. If the stock goes to 426, well, by virtue of delta, my stock will get some profits, and in which case I can always roll up my call. That's the general rules of getting out, okay? In this case, I don't need to get out. My next consideration is, do I want to do a rollover? Why would I do a rollover? Because I'm getting close to the expiration of my front month options. And in this case, the April 21st options, as you can see, is 28 days away, so I'm not going to change that. Okay, so no change to be done. I'm happy as the stock goes up. Take a look at the chart. Yeah, it's moving up. It might even reach a new high. So why would I change it? No, wait. You can still get some more profits, even if it goes down from here. If it does dramatically, well, the volatility would spike, and then you make additional money. For now, let's just leave it. Let's move on to AXP. Well, this is the opposite. The stock has been moving down. You see how it jumped up and it looked like it was going to reach new highs. It did, and then pulled back very strongly. Well, if you are here and you take profits by selling some of your outstanding call or rolling them up, you took your profits. Now the stock goes down, you make additional money. Let's go to the Analyze tab in this case. And I did a roll up, and a roll down, as a matter of fact. You see this 155. Okay, I didn't make any changes on the calls on the call side. They're all 180, 180, 180. But the put side, I did. I rolled it down. Why? Because the stock went down to 150, so I rolled down my outstanding puts. I had 4 180 puts, so I sold 2 of those and bought 2 at a lower strike price. Why? Because I want to keep the dream alive that the stock might go to 130, and if it does, then you are collecting money, additional money. Okay. I'm not going to make any changes. April 6th is next week. You can see 6, okay, 13 days to expiration. So next week will be March the 31st. If I had March 31st short front month options, I will roll them over to a month from now. Because they are April 6th, 13 days to expiration, I can wait 1 more week for those. Let's go to BP. BP, let's take a look at the risk graph on March 31st. Okay, these are in fact less than 1 week to expiration. If you say add simulated trades, yeah, that's 7 days to expiration precisely. So I might want to do a rollover. Let's go to BP, and you can see that I already had a rollover. So what does that mean to you? It means that oh yeah, this one, what I did was I sold some of it. You see how I had my original position 28 long, 14 shorts, and I sold half of it. Okay, so let's take a look. Analyze trade, high simulations. This is the original trade, and then I sold half of it. Analyze trade. Okay, So the new trade, as a matter of fact, is this analyze trade. We sold 14 long calls, so now we are left with 14 for the longs and 7 for the shorts. Okay, so but obviously that was an adjustment. We sold half of my position, so I started with 704 and I got a credit of 7.77. So if you want to calculate it this way, hold on a second, calculator again. If you want to calculate it this way, you started with a position at 7.04 times 100. My original cost was 704 times 14, okay, 9,856. We can save that here. And I got out with 7.77 times 100 times 7 because I sold half, so that's 7. Okay, that's the minimum common divisor. That is 7 times 7. That's how much money I got. So I'm going to subtract this credit from my original position, which I have here. So I'm going to subtract by subtracting the memory, and then recall this is my new cost, and divide that by 7 because it's 7 lots is what I have. So divide that by 700. Okay, so the resulting price is $631. Let's copy that. Divided by 100 is 6.31. There you go. That's my new cost. It should match. Okay, so let's take a look at the risk graph. Deselect the final resulting here. So the combination of these two trades gave me a profit of 996, a delta of 354, and a vega of 197. Okay, so the resulting 1015 should be the same. Okay, you can see that they match. Okay, so I can delete the other two. This is my new position. What if I was to remove it? Analyze the opposite. Deselect. Okay, I will get $7.13 out of it. And I get, in the end, considering all the money we already got, in the end it will be $574 profit. Okay, but I want to do something different here. We have March 31st, 1 week to expiration. Because we're 1 week to expiration, we should be starting thinking whether we want to close the trade or change it in some way. And what I want to do is to roll it over, because when I say that, I say analyze rolling, and it's right here. I'm going to adjust this to somewhere in April, by the end of April, let's say the 28th, okay? And that gives me 27 cents. For some reason that doesn't match. Let's see, high position. Okay, so we're selling. Oh, okay, we want to sell. Yeah, buy back to March 23rd. Give me just a second here. Let's close this a little bit. Yeah. Okay, so you can see that I have, my current position has this March 31st, which expire next week at a 40 strike price. And I'm buying those back, 7 March 31st, and I'm selling the April 28th, and for some reason I get 27 cents, which seems not good. Let me see, this is like that. That's what it looks like now. And I see that the put side says NA, no applicable. This 0 is not, there's something wrong here. That there is no volatility on my put side. That's what it's telling me. So it makes no sense. So let's do the call side and the put side separately. Okay, so I'm going to do the call, analyze rolling. And I'm going to buy back the 31st and sell the 28th. And that's 28 cents for the call side. It just doesn't add up. It doesn't seem correct. Analyze trade, the same thing, just change for puts. 7. Oh, okay, let's say reset that. Reset parameters. Reset parameters. And reset slices here. Oh, okay, that's because I'm looking at the 40. Yeah, you can see the current price is actually 35, not 40. I was looking, how come it's 40 so low? Usually when you are at the money at the same strike price as the position you have, it should be a larger strike price. Okay, I tell you what, because we are here below our position, if you hide the position, just show me the simulation alone. Let's delete this. I'm not going to do this just yet. Okay. You can see that I have $533 in profits. And you can see that the smiley face is up here. We are below the smiley face. So what does that mean to me? It means I'm going to sell puts or roll them down. In this case, because I have 7 short puts and 14 long puts, I could sell 1 or 2 or 3 of the long puts, and that reduces my cost. Here, analyze closing and just sell. Let's hide that, hide the position so that we can see our current. If I were to sell 14, well, obviously that's not what we want to do. We want to sell just 1 put, and without the sell, my delta is minus 20. With the sell, minus 200. With the sell is minus 120. I could sell 1 or I could sell 2. Selling 2 gives me minus 33. Do I think that the stock is going to drop significantly? Yeah, it's looking like it's going down further. So I'm going to just sell 1 for my profits. Okay? And get $525 out of that. Let's just sell 1. Okay, $525 minus commission. And then I can do the rollover of the put side. The call side can wait till next week. Okay, but I'm going to do the put side. Analyze rolling. And what am I going to sell instead of the... Okay, it just sold my put. Great. But I'm going to do the rollover from buying back the 31 short put and selling the April 28 put. Okay? And doing just that gives me 10 cents. Okay? Well, it's no big deal, but what I'm doing is making sure that if the stock continues to go down, this will be even less valuable. So yeah, I'm just rolling it over so we have those puts further to the, in case it bounces back up. Okay, confirm and set. That's why we do those, and we wait until that gets filled and move on to CRM. CRM is here. Okay, CRM, let's reset our slices. Make sure you do this reset slices just to make sure that we are in the right spot. And the current stock price is above my smiley face, as you can see here, the apex of my smiley face. Okay, so what do? Well, I can roll up if I have additional calls. So we have 2 short calls, 1 long call at 150, 4 short long puts at 150, and we're way up here. But I noticed that I have 185 call, and the strike price, the delta is 13. Well, we are way above 185, so I can roll this up even further. Analyze rolling, so that as the stock goes up more and more dramatically and less probable, we are selling an additional call at a higher strike price, and meaning we're selling the long call and buying a long call at a higher strike price, so as a way to make additional money. So I'm going to buy the 190 at the same expiration, May 19th, and that gives me an additional $275. Okay, and see how that my apex, my current price looks closer to the apex here of my smiley face. Okay, you can even go further to 195, and that neutralizes my delta completely. Okay, do I think the stock will go dramatically down from here? Well, yeah, possibly. It's giving me some weakness here. Yeah, let's do that, and you still have it open to additional profits if it goes further higher. Okay, so let's confirm and send that. We have now our long call, it is now 195. The 185 is out. The call, this 150 call, is covered by the short 2 and 2. Okay, eventually all these things will be neutralized, and if the stock collapses, then wow, we will be very happy, because then we would be additional money at no additional cost. But that's like, you never know what would happen, and the point is to have my delta neutral, so that it doesn't matter to me whether the stock market goes up or down. Let's go to Google here. Google. Okay. In this case, you can see that the stock price is well below the smiley face, so there's nothing to do here. We look at these shorts, April 21. If you want to see whether we are making money or not, simply analyze the opposite and compare the 2 prices. This unlocked and this locked, because we already paid for that, and this will be the price if we were to sell right now at an additional price. You can say high position, and then it tells you, well, I made $202, no big deal, nothing to write home about. But there you have it. Okay, we might want to do a rollover. Not in this case, they expire on April 21. So I move forward to LEN. In this case, April 14. Yeah, nothing there. Let's take a look at the actual position. You can copy this to the analyzed trade and see what the opposite is. It's a small loser so far. These things can change in a hurry, so don't worry about that. Let's go to PANW, that's Palo Alto Networks. Okay, it looks like I already made a rollover, so let's look at this from this perspective. Monitor, yeah, we had the original plus a rollover. So to take this to the Analyze tab, simply right click and say Analyze Trade, go back and say Analyze Trade again, and now this is your position. If you want to see if instead of those 2 you want to have 1, modify it, Analyze Trade, and it should be exactly as what you have, which is instead of March 24th, now it becomes April 21st. Okay, and the price is 45.65 minus 6.28. So 45.65 minus 6.88 That's 38.77. This trick works as long as you have your rollovers have the same number of puts and calls and they match your shorts, and the longs are even as well, so then it's easy to calculate, and this should match. Let's say high position, and this is the 2 trade, gives me a profit of 575, delta of 24, vega of 204, and here you go, the same numbers. Okay, so we can keep this already, and if we were to close, simply say analyze opposite 41. Okay, so you could sell it if you want. Let's take a look. It's going to make a new high. It's giving me sell signals here. So I don't know. Let's reset the slices. Reset slices here. Reset slices. Okay, so then the middle one is where the current price is, right in the middle of it. Hide simulations, hide positions, deselect this one, and that's my current position. And I'm happy with that. There's no need to roll anything. My shorts expire on the 21st. There's plenty of time before that. Let's go to STX, show all. Okay, I have made adjustments. As you can tell, we have only 8 puts. Okay, so as the stock was going down, I was selling puts, and now I have 8 puts, 10 calls, and 5 shorts, puts and calls. Okay, let's go to the monitor tab, and here you can see what I've done. Okay, you can copy those, and if you have done something similar, and then you would see what your profit and with reward is, or you can simply say look it up STX, because our trade started here in January this year. You should be able to see the P&L from here to date, and it says minus 35. It's a slight loser, no big deal, not really much. Okay, so what do we want? Do I want to adjust? You can see the current price is above the apex of the smiley face. Let's look at the chart. I think the stock may be going down some more. I'm going to leave it alone. Okay, you never know how much it's going to drop. What if it went to 30 for whatever, a piece of bad news, and then the stock is 30? Well, then you have $5,000 just for sitting there doing nothing as far as you're concerned. Okay, let's leave it like that, and hope that something like that happens, because they tend to be very profitable. Very good. Now I have 2 trades that I am suggesting to you: FedEx and Intel. Okay, let's start with it, FedEx. Let's copy that, or let's start getting the data here. Chart, Intel, and let's start with the earnings. The earnings were way back here, but the stock has been moving up. It pulled back and then very strongly moving up. Now the volatility has risen, so that actually eliminates it. I entered it this week, but the volatility was low, and now it's picking up. So yeah, this candidate is no longer valid. And the other is FedEx. FedEx spiked with earnings. Earnings was coming in very good, beat expectations by a wide margin, and the volatility may be rising here. Let's see if this is valid. Okay, let's go to FedEx and start with my earnings. It was 341. The estimated is 267. So we enter it here. Expected was 2.67, and the actual, oops, let's see. Hold on here. $2.67, and the actual was 3.41, which makes it 27% earnings beat. It's just great. Okay, let's go to the trade. I'm going to copy it from here. And what does it cost me? What does it cost me? It's $50.13. I think I can do two of these. 50.13, and we're going to do 200. Let's just say 2 instead of 4, and that's $10,000. Great. Okay, you can put the expiration, whatever. I'm really doing 2, but I'm not going to bother changing those in the interest of time. But 2 of these would cost me $10,000. So I'm going to copy that and paste it. And then analyze. Okay, so I want to open it so we can see the, and I'm not going to do 6, I'm going to do 4, 4, 2, and 2. Great. So what do I do now? First, we need to see what the liquidity of it is by saying create duplicate, and we use these two numbers, 4940 by 5020, and enter them here. 4940 versus 50.15. Yeah, that's 1.5. This is actually a trade, and I'm going to change the color to green. Right. Okay, so now we're going to do the analysis of the volatility skew and the current IV percentile. So to go to the current IV percentile by taking a look at the trade tab, all products, make sure it is FedEx, scroll down, look at the current IV percentile, that's 27, that's a little more than I would like. 27, okay, that's a not trade, so I have one strike against me. Put it in orange here, and then let's look at the liquidity is okay. Let's look at the volatility skew. So go to the trade tab or the analyze tab and look at the volatility skew. Okay, so starting with the long ones, back month. So you can look at the numbers here, the volatility at the bottom right corner of your screen. So let's do 36.27, 28.54. Okay, and for the front month we have 33.77, 28.79. In case that wasn't clear enough, here you see the call puts. The top is the long month expiring in July, and the front month are short, negative, and expire on July the 1st. Okay, and then these are the numbers, and I put them carefully in my spreadsheet, and then I can see that my skew is minimal. And as you can see, the volatility of the back month is 32 versus the front month is 31. So it's okay. The fact that is current IV percentile is a little high, agreed. Okay, so you may decide not to do it, but I'm going to do it anyway. I think it's one strike against it only. So let's enter this trade, create duplicate, and then confirm and send, and here you would see that it's $9,870 plus the commissions. That's my trade. Okay, less than 10% of my account. Yes, my account is 100,000, so yeah, it's very close to it. And then send. Okay, and that's about it for today. Thank you very much for joining me, and see you next time. Bye bye.